Well, it's often said that fear and greed are the two emotions that drive the markets. If that is the case, does the small investor stand a chance in today's increasingly complicated investment landscape and with Wall Street's ability to capitalize on those emotions? Well, back with us is Lou Day, managing partner at NS Capital in Stamford, and Todd Peters, chairman of investments also with NS Capital. Good to have you back. Let's talk a little bit about this fear and greed. I mean, it's there.
Yeah, well, let's start with the saying that, you know, fool me once, shame on you, fool me twice, shame on me. Investors are in the second category now, okay? We have been fooled in the last 10 years by Wall Street in terms of their ability to manufacture and distribute products that are absolutely tied in to the fear or greed of the moment. Let me just go through them quickly.
Yeah.
In 1999 to 2000, it was all internet funds and new economy funds. Then after the bear market in 2001 and 2002, in 2003 they came out with principal protected funds, which were mostly bonds, just at the time that the market soared. Okay, the next thing is on the hedge fund craze, they came out with things called 130-30 funds, which were hedge fund-like mutual funds that came out. Then mortgage-backed securities, and today we've got all kinds of bond product, okay, as well as low volatility equity product, and gold, of course, is the big one. So I can say, you know, without any reservation that people that invested on the products that were being promoted, on the emotion that existed, whether it be fear or greed at the time, did awful.
Well, let's just take, like, for example, the internet bubble that existed. I mean, I remember it well, and so many of us thought, wow, this 30-year-old, no, a multi-millionaire, and I'm the dope that's sitting on the sidelines, you know, with my very diversified, you know, small monies that I have. So we all want to kind of, there's another mentality, and that's the herd mentality. We don't want to miss out.
300 funds, okay, were launched in 1999, and now 300 mutual funds, okay, in 1999 and 2000, just to capitalize on that statement you just made, okay? Don't miss out, you know, give your money to us, et cetera, et cetera. Of those 300 funds, I would be surprised, okay, if there are more than 10 left. Most of those funds performed terribly because they got in at the end of the bubble. They attracted, you know, billions of dollars of capital, which really did a terrible job for their investors. Then, in order to get that track record, that poor track record, off the books, they either closed those funds or they merged them with other funds. And this is what I mean about fool me twice. I mean, this is going on now in every bubble and every bear market that we've had.
Well, would you say that's true now of gold?
Absolutely. Well, I mean, you tell me.
But gold is a tangible asset. You know, you've got the gold, or unless you're investing in the stocks of companies that mine or whatever it might be. So at least I feel like I've got something tangible. Yeah, I mean,
it's something tangible, but it's also not something that pays a dividend, okay? So it's not something you can, that can produce anything, so it's a static asset as well. But, you know, we have gold in our portfolio. We're very happy to have had it in the portfolio for percentage. But the idea of what's going on with gold today, okay, when it's at an all-time high in history,
1,300 something.
1,300, and now is when gold is being promoted. You cannot turn around and not see an ad about buying gold. And as I said, we're happy to have it in the portfolio. Would we be buying it now? No.
Yeah, so it's very hard, Todd, then, for the individual investor. They think, okay, I buy the funds because I'm not savvy enough to be an individual, a picker of stocks, for example, in the equities market. So that's why I gravitate toward funds. You know, I don't have the inside information that the professionals would have. I don't have access to that, so I'm not going to be ahead of the curve, or I can try, but it's going to be very difficult for me. I mean, what does the individual investor do?
It's a very difficult question. We are believers in having specialists manage for our clients. So the thought of bringing in a specialist or a fund manager is a great idea, but unless you have
a good one though, because you can get sucked into some of these same vehicles with somebody who poses or who is a professional. However,
you're exactly right. If you don't have the time to really study the managers, study their products, understand exactly what they're in and why they're in them, it's a very difficult business for people that have full-time jobs and are doing their other things in their lives to then be able to make the right determinations. We spend a tremendous amount of time trying to pull back all the layers to make sure we understand exactly how the companies are run, how they do their business, how they build their portfolio, and most importantly, how they're going to manage it going forward. And I'll tell you, we have a hard time sometimes making sure that we're making all the right decisions. So for the individual investor to try to understand this, I would say either go to use index funds if they want to try to do it themselves, because at least you're getting a basket of securities. But if you are looking to go the professional route or through a mutual fund, you need to find somebody you think can actually help you pick and choose the right funds and build the right portfolio.
All right. Well, we want to thank both of you for joining us today. It is NS Capital and located in Stamford. Lou Day, Todd Peters, thanks again.
Thank you.
And that's all for this week. We'll see you next week on 12 on the Money. I'm Rebecca Saran.